Hi there. In this video we're going to be learning about lender's yield, the effective borrowing cost, and the annual the APR, the annual percentage rate, and then we're going to show how you would calculate these items for a given loan. Alright, so let's start back with the lender's yield. And so basically what this is the lender's true profitability on the loan, the lender's internal rate of return. Most people think that only consists of the lender only gets the interest rate, but the lender gets interest rate plus a variety of different expenses at closing. So what we want to do is compute both of those into state it as an interest rate, and so that's the lender's yield. Quick note about lender's yield is lenders do have to make some kind of assumption about when prepayment occurs. Typically this is around month 60 or 5 years, but in different markets, it can go longer or shorter depending on what kind of prepayment they're experiencing at the moment. Okay, so effective borrowing costs, because we have the borrower has to pay both interest and closing costs, and then most likely the holding period is going to be different than we're going to have some kind of finite holding period. We're usually not going to hold the mortgage all the way to the maturity. When those things are the case, we have to compute our effective borrowing costs because that holding period is going to change the result. So basically what we're going to do with this calculation is to convert the interest rate and any kind of mortgage related closing costs that we have to incur all into an interest rate in terms of present value. So a couple of notes about this is the calculation is very much like how you calculate the lender's yield. Also there's a relationship, since we have to, and this is the general relationship that holds, is that the mortgage interest rate is usually less than the lender's yield, which is less than the effective borrowing cost. And the key insight there is to show that on the EBC side of things, we want to include all mortgage related closing costs, those paid to the lender and those not paid to the lender. So here you see some examples. On the lender's yield, we're only going to include those expenses going directly to the lender that lender gets to keep. So the discount point, the origination fee, underwriting fees, those are typically the three sources of revenues for the lender at closing. But then, we usually have to pay other things like PMI, taxes on the loan, title insurance, appraisal, surveys, all that are related to the mortgage, because the mortgage company is making us do these things, and so therefore we would include it. A key point is that if we do not want to include expenses if they're not related to the mortgage. So a prime example of that is the mortgage recording taxes or the closing attorney. Not the mortgage closing taxes. Those are related to the mortgage. They just don't go to the lender, so you would not include those in the lender's yield. But the closing attorney, you're going to need that regardless of if you have the mortgage or not. So since it's not an incremental cash flow, we would not include that in the effective borrowing cost. Okay, and then the relationship between the EBC and the APR is that the APR is when we hold to maturity. So the APR is the EBC calculation over the term or the complete term of the mortgage. That's not likely going to happen. Most people prepay the mortgage between 3 to 10 years. And so once you have a different holding period, you're going to have to recompute your effective borrowing cost. Okay, and that's the answer. What inadequacy might you receive in the APR as a measure of true borrowing cost? The inadequacy is that most borrowers don't hold to maturity. Okay, so that's a brief overview of these three. So let's go and see how we would calculate it. So we have three different mortgages that we're going to take a look at, and we're going to compute the EBC and lender's yield of each one. In this first case, we see that prepayment, we have no prepayment. The loan is held to maturity. We're going to hold this loan for all 30 years. So what I'm going to do is I'm going to compute the problem number 1 second. All right, I'm going to go ahead and do problem number 2 first, just because this mortgage, the problem 2 mortgage and problem 1 are exactly the same, except for we have prepayment occurring at the end of year 3 in problem 2. So I'm just going to work that one first, and then we'll take out the outstanding mortgage amounts, and we'll see how that gives us the APR. Okay. So a few things we need to do before we get down here into a 3-step process. Property sales price $150,000, down payment 20%, and so our loan amount is going to be the purchase price times 1 minus the down payment. Okay, notice that that's the same thing as saying that 80% loan to value implies a 20% down payment. Okay, so loan period 30 years, that's the term. Prepayment occurs at the end of year 3. Interest rate discount point is 1.25, and that's of the loan amount. All right, so I'm going to go ahead and maybe highlight this in yellow to signify that's the one that we're interested in. The loan origination fee is a percentage of the loan amount, and then here's the lender's underwriting fee. So lender's fees, we might go ahead and sum those up. So lender fees is going to be equal to the discount point, the origination fee, and the underwriting fee. It does not include mortgage recording fees because those are county taxes just to record the mortgage document. Okay, so those are lender fees. Total fees, this is for the EBC side of things, includes the lender's cost plus the appraisal, the survey, and the mortgage recording costs. Okay, so with that done, we're now ready to compute each 3 of the steps for the effective borrowing cost and lender's yield. So the N is going to be, we have 30-year mortgage, so it's 30 times 12. The interest rate is 6, so we divide that by 12. Our present value is 120. And then we're going to compute payment. Step number 2, we compute present value. Step number 3, we compute our rate. All right, each value is going to be 0. So the payment is we're going to use our payment function, rate, N, present value, future value. All right. Step number 2 is to compute outstanding mortgage balance. And so, again, remember that we're going to change our N to the number of payments that we have not made at that time. So we have a 30-year mortgage. It says prepayment occurs at the end of year 3. So we're going to subtract off 3 times 12. So that's the number of payments I will not have made by the end of year 3. And our definition of outstanding mortgage balance is that we're going to use the contract rate of interest. And let me get that formatting straight. And we're going to be discounting the payments. The future value is still 0. So compute the present value using this information. All right, so 115,000 is our outstanding mortgage balance. So step 3, we compute the effective borrowing cost, and this represents, step 3 represents our holding period. So our holding period is 3 years times 12, right? So one way that you can check to see if you're correct is that these two ends should equal up to the total, right? And so 360 we see down here that it equals 360. So the payments that I do make plus the payments I don't make must equal to the total number of payments in the mortgage, okay? And so we're discounting payments, and remember our outstanding mortgage balance, we need to flip the sign when it comes down. So this payment just drops down, and this present value that we calculate comes over here. We need to make it negative because we make 36 monthly payments of this amount, and then at the end of the 36 months we have an outstanding mortgage balance to pay. So these two are on the EBC side of things, these two are going to be negatives. Okay, so now in present value, what we're going to do is say, okay, start off with the loan amount, and that's $120,000. And since this is EBC, I want to do total fees paid, and that is equal to minus 5,000. And so on a net basis, we only net 115,000 at closing. Okay, so we're now ready to compute the I, and I'm just doing a quick check to see if my necessary condition for computing I or N is present, and that condition is that these three cash flows cannot all be the same sign. They have to be different. So we have a positive, negative, negative, and so this makes sense. I'm receiving money at closing. I make 36 monthly payments of this amount, and at the end of the 36 months, I have a payoff balance of that. So those signs do make sense. So we're going to use the rate function, and we just reference our information that we've already computed. And then the key thing, multiply that number times 12, because what you get is a monthly number. we want an annual number, format that in terms of percentages. We see that 7.59 is our effective borrowing cost. Takes into account their interest charges, takes into account our outstanding mortgage balance, and takes into account these fees, so that effectively our rate is, given all the information, is really 7.59%. Okay. Now let's see how that looks, what that looks like for the lender. And since I've already done this, it makes this stuff over here really quick. For the lender side, remember these signs have to make sense for the borrower. These signs over here have to make sense for the lender. So on a monthly payment, on a monthly basis, lender receives payments. So this is a positive number for lender. Okay, this outstanding mortgage balance that they'd calculate based on that, right? So step 1 is payment. Step 2, present value, is the outstanding mortgage balance. Step number 3 is the lender's yield. All right. So the borrower determines the N. So 36 is going to be the same as lender's yield as it is over for the effective borrowing cost. We're going to calculate payment. This payment is just going to drop down, and this outstanding mortgage balance, again, we're going to flip the sign when it comes from here to down here, because again, this is the lender, so the lender receives monthly payments and they receive the outstanding mortgage balance payoff. Okay, so just like last time, we're going to adjust our present value is the adjusted, that's the loan amount adjusted for closing costs. So the loan amount is 120, and then lender fees is equal to $4,200. And so oops, I already messed up the signs on this. So remember, signs have to make sense because this is the lender. So the loan amount is actually a negative. It's a cash outflow. Lender has to bring that much money to closing. Okay. The lender fees, that should be a positive number because lender is receiving those fees. Right, so that's going to be positive, and so the net amount is going to be just the difference between those two, or 115,800. Right, so let's see if these signs make sense. To compute I have to have, these three can't all be the same. They're not the same. This is the negative, which makes sense for lender because at the day of closing, it's a net cash outflow, whereas the rest of the time they receive cash inflows. So those signs make sense. Compute the rate, get the N, payment, present value, future value. Go ahead and close that up. Multiply times 12 to get our annual rate. Format it as percentage, and we get 7.33%. Okay, so see if our general relationship holds up, and we said that the interest rate is typically less than lender's yield, which is less than the EBC, and so in this case the interest rate is 6%, and that is less than the lender's yield of 7.33, which is less than the EBC, so that checks out. Okay. So that's problem number 2. Let's now go back and look at problem number 1, which is this same mortgage. Is just that it doesn't have any. We don't have a prepayment, right? So loan is held to maturity. I'm just going to copy this information here up there for simplicity's sake. And what's going to differ is that we have no step 2, okay? So we have no outstanding mortgage balance. So the number of payments that I won't be making at the end of year 30 will be 0. And of course, you put that in there, it's going to compute the 0 outstanding mortgage balance. While holding period is no longer 3 years, but 30 years. So that's going to be 360. And so all the other information will be the same. We see that the effective borrowing cost is 6.4. Compare that number versus 7.59. So the APR on this mortgage would have been stated at 6.4. which might have induced us to get into a loan, but because of our early prepayment, the 3-year prepayment, our effective borrowing cost is actually 7.59 rather than the 6.4. And the reason being is because all those fees that we have to pay, this $5,000 in fees, in terms of present value, is much more significant in the 3-year holding period than if it's spread out over 30. Okay, so we see that computing your EBC really does pay off, because we might have picked a different loan had we known that to be the case. Okay, so the same thing over here on the lender's yield side. The end changes to 360 because the borrower has saying that they're not going to prepay. Everything else remains the same. We see that their lender's yield is 6.34, which again is less than the 6.4 EBC because they don't receive all the closing costs. They just receive $4,200 of that. Okay. So now let's move on to problem number 3. This is a quite involved problem because it has both a prepayment as well as PMI. PMI is private mortgage insurance, and lenders typically require you to pay this when your loan to value exceeds 80%. In this case, we have 95% loan to value, implying that we only put 5% down. So our loan amount is going to be 200,000 times the 95%, right? So again, I'm going to color that. And then, just like last time, start computing out my fees. So my discount point is a percentage of the loan amount. Oops, let's reformat that. My origination fee is a percentage of the loan amount. And then underwriting fee, that's just stated. Appraisal, survey, mortgage recording fees. All right, so let's go ahead and, like last time, get lender fees, and then total fees. So lenders includes the discount point, the origination fee, and the underwriting fee. Okay. All the other fees include the lenders, plus the appraisal, the survey, and then the mortgage recording fees. Again, the mortgage recording fees are just taxes paid to the county. Right. If I had a closing attorney, just to reemphasize this point, if I had a closing attorney and that was, say, $500, you would not include that in either one of these calculations because it's not related to the mortgage. So if that was on there, the closing attorney, I'd color that red because we don't want to include that for anything. Okay. So we have our lender fees, hit F2 on your keyboard, F2, lender fees, F2 for total fees is the lender plus these 3 right here, but not the closing attorney. Okay, the private mortgage insurance, the best way to think of this is a closing cost that's paid on a monthly basis, and we'll take a look at that at the very end. Accordingly, when you think of it like that, you won't be tempted to put it here up in here into your payment or outstanding mortgage balance. It belongs only up here in step 3. All right, so in this problem, the N is the 15-year mortgage, so 15 times 12. Interest rate is 4 3/4. My present value is 190. So compute payment. Future value is going to be 0. It'll be blank too. All right, so there's my monthly payment. Step 2, outstanding mortgage balance. It says prepayments occurs in year 5. So our end calculation is our 15-year term mortgage minus the 5 years where prepayment occurs, multiplied times 12. Interest rate drops down, payment drops down, future value drops down. So we compute, color these real quick, payment, present value, then I. So my present value is rate, in, payment, future value. Okay, so now I'm ready for the holding period. It says prepayment occurs at the year 5, so my holding period is 5 times 12. So again, note that these two ends will equal my total. The payments I do make plus the payments I don't make equal total payments. The payment continues to just drop down. The outstanding mortgage that I calculate drops down, but its sign flips because it's a cash outflow. My present value is equal to my loan amount minus total fees. So the loan amount is 190, and then my total fees are 2,800, and so the net format that, and so I had to have an extra zero there, so let me take that off. Alright, so 190, 2,800 in total fees, so that is my present value. So for the borrower, I have 60 monthly pay. At closing, I net 187,200. I have 60. My holding period consists of 60 monthly payments of this amount. At the end of the 60 months, I have an outstanding mortgage balance to pay off there, and so compute the rate. And then multiply times 12 to convert it to an annual rate, format it in decimals, in fractions. So we have 5.13 is our outstanding, is our effective borrowing cost. But I just forgot that my payment, I haven't accounted for my private mortgage insurance yet, so I forgot about that. So it says 1% of original loan amount paid per year, paid monthly. So what that equates to is 1% times the loan amount divided by 12. Okay, and so I need to compute. This is wrong here. So let's do monthly principal and interest. Actually, I'll just say principal and interest, then PMI. Let's say total. So PMI is my monthly payment. PMI is going to be equal to this amount that I calculated right there. So that the total right there. So I just plug that back into my formula, and you get 6.27%. And so now that's correct. So watch out for your loan to value. Make sure that there's no PMI, because if you do, again, PMI is best thought of a closing cost that occurs on a monthly basis. So only include PMI in the step 3 calculation, because if you don't, it's going to screw up your outstanding mortgage balance and your calculations in general. So only include it down here at the bottom in step 3. So this is probably the most complicated problem that you can run into in terms of computing the EBC. Right? So let's finish up and see what it looks like for the lender. So again, the lender, these payments are positive, and so we just flip these signs. And so go ahead and color. So step 1 is payment, step 2 is the outstanding mortgage balance, and step 3 is going to be the lender's yield. 60, the borrower determines the holding period. The payment just drops down. The future value is the outstanding mortgage balance with a sign flipped. So these are both going to be positive. The present value is going to eat out to the loan amount, which again for a lender is going to be negative. So it's 190,000 negative. And lender fees, they're going to receive a positive $2,100. And so the net, add those together. Let's reformat that, make sure I didn't add an extra zero that doesn't supposed to be. Okay, so that's good. So that's my present value. So again, I have negative, positive, positive, which makes sense. So I'm ready to compute the rate. In payment, present value, future value. Multiply your answer times 12. You get 5.03. Okay. So lender's yield 5.03. That's greater than interest rate of 4.75, and then the EBC is greater than the lender's yield. So again, that relationship that we said right here, that does hold right here, which means that it's a reasonable answer. So that's how you calculate EBC, lender's yield. And again, when you don't have a prepayment, when the loan is held to maturity, the EBC calculation is equal to the APR. So hope this video has helped you.